Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. President Trump extends the Iran ceasefire while maintaining his Hormuz blockade after talks collapse, and Pakistan urges the US to hold off on strikes. Goldman Sachs CEO David Solomon quips that recession risk is just one tweet away as the Hormuz closure hits oil supply and raises global downturn fears.
Are you going to be the president's human sock puppet?
Senator, absolutely not.
Are you going to be anybody's human sock puppet?
No, I'm honored the president nominated me for the position, and I'll be an independent actor if confirmed as chairman of the Federal Reserve.
Kevin Warsh repeatedly pledges to act independently if he's confirmed as the next Fed chair, rejecting Democratic concerns he would bend to Trump's demands for lower rates. And JLL Real Estate Management Global CEO Neil Murray is going to join us to discuss how he sees the Iran war slowing deal decisions and the risks ahead. Our top story today. President Trump says he's extending the ceasefire with Iran but maintaining the US blockade of the Strait of Hormuz. In response, an advisor to Iran's top negotiator has described the truce extension as a US ploy to buy time. The high level of mistrust means plans for a fresh round of direct talks fell apart shortly before they were due to happen. Let's get more from Horizon's Middle East and Africa anchor, Jemana Besetche, who joins us now from Dubai. So, Jemana, the ceasefire is extended until talks have concluded, but there's no talks. So where does this leave us?
Yeah, I mean, a lot of ambiguity here about what happens next. And I will say we spent a good part of yesterday trying to figure out whether these Islamabad talks were actually going to take place. There was certainly an intent from the U.S. side to send a delegation. We spent a lot of the day trying to figure out if J.D. Vance was actually physically going to get on a flight to travel to Pakistan. Islamabad, the city, had done a ton of preparations in anticipation of these talks. But in the very final hours, it seems as though the possibility of talks collapsed, and namely because the Iranian delegation never actually made a firm commitment to attend. So in the early hours of the morning, President Trump put up that Truth Social post saying that they had agreed to extend the ceasefire for an indefinite amount of time, he says, until Iran submits a new proposal and discussions are concluded one way or another. He says this came at the request of Pakistani mediators, that they will halt attacks, but at the same time also reiterated that they're going to maintain that U.S. naval blockade. Now, this has prompted a response out of the Iranian foreign minister, Abbas Araghchi, and he said that blockading Iranian ports is an act of war and thus a violation of the ceasefire. And so we go back to the original discussion that we were having yesterday, which is the Iranian stance has been that they will not enter into a second round of negotiations so long as the blockade is in place. And President Trump had a couple of options. He could have lifted the blockade momentarily to induce the Iranians to come to the table. He could have stayed on with the blockade and called their bluff, which is exactly what they're doing. And then the third option, which is still very much still an option now, if you think about where this could go in coming days, is perhaps just buy time for the real possibility of another round of military strikes and an escalation once again of the hostilities on both sides.
Yeah, let's get into that a little bit more, because there is a report that Iran's top negotiator is warning that this ceasefire is just a ploy for exactly what you described. So what could potentially happen, and what's the foreign minister saying?
Look, fundamentally, there is a lack of trust between the two sides. And what the Iranians say is there have been multiple attempts of negotiations, even before the war even started, where they describe as very close to a deal. And then in the last second, the U.S. changed tact and went for the attacks. That happened with the 12-day war in last year. It happened this time around those Geneva talks. And so even President Pezeshkian yesterday put up a post saying that there's a fundamental mistrust between the two sides. So there is an element, and certainly you're hearing it more from that hardliner group of individuals within Iran, those that are associated to the IRGC, the Revolutionary Guard. They perceive in their interest for the U.S. naval blockade blockade to continue because it gives them a pretext to perhaps continue with the war and continue to inflict economic damage on the Gulf and on the global economy. At the same time, you also need to look at the deployment of U.S. military assets in the region. If anything, they've been beefed up over the course of the last week. We know that there's another aircraft carrier that has been deployed to the region as well. There are thousands of troops, ground troops, that could, in theory, be mobilized too. And so there certainly still is the question of whether Trump decides to pull that trigger, whether that could lead to another round of escalation. The bar is a lot higher than it was before, but it is certainly not outside the realm of possibility. And I think we're walking in this morning to a situation of maximum ambiguity because there is no resolution and all the options are still on the table. Plus, the strait is still effectively closed.
All right, Horizons Middle East and Africa anchor Jemana Baset there in Dubai. Thanks for that update. Joining us now is Hebe Chen, Senior Market Analyst at Vantage Markets. Hebe, thanks for your time today. And, markets are looking through this whole Strait of Hormuz closure at the moment. How long do you see the conflict being locked in this unresolved state?
Good afternoon, Paul. Well, yes, I think today we just welcome another mini chapter when the market is waiting for the peace talk. Well, how long? I think the future market or the predict market is now seeing that it's quite unlikely the whole conflict will resolve by the end of this month. So very much likely will drag on into the new months. And what the remove of the clock for market today, I think that on one side is showing that the imminent alarm has been resolved, but on the other hand, what could potentially open the door for the more uncertainties? As the previous mentioned, it could be the play that we're going to see more of the mini play from both sides. My personal expectation is that I think this is definitely will drag on, but market is getting to sort of getting adapted to this changing back and forth, and is showing a bit of the cautious but still positive signs showing that direction will still towards a peace talk.
Well, we've got the oil price up a little bit in the meantime. Brent just above $98 now. We're above where we were yesterday. But we're in this very narrow range, aren't we? I'm wondering what your outlook for the oil price is from here. And I'm assuming you've got a number of scenarios you're thinking about.
Well, yes, as you mentioned, the oil prices stayed above 90, and this $90 price tag is just roughly about 20% above its pre-war level. So in that sense, I would say that the oil market isn't overpricing now. It's just probably more reasonable pricing into war premium. And this war premium speaks for such a critical bottleneck control 20% of a global oil supply. While in terms of outlook-wise, I think if there's someone asking when the oil price could potentially retreat back into the pre-war level, I would say they probably are taking much longer because now given it's quite reasonable response and pricing in for the supply disruption, not speculation. This is a fact-based. That means the market will have to wait for a very, very clear sign that this supply disruption can be resolved meaningfully, sustainably, until that we will see the oil price potentially back below 80. And before that happens, I think the oil will stay elevated at current level for the weeks, even months to come.
And of course, real economies around the world are dealing with these elevated prices, and not just oil, it's fertilizer as well, and eventually food. So what are you modeling in terms of inflation?
Well, exactly. I think that 20%, if that's the new norm for the oil prices that all the economy have to adapt to, that means how much this 20% would translate into the inflation. As you mentioned, the food prices would likely we're seeing this whole reaction trends that will enlarge and that will probably extend into the end of this year even longer. And that will it's multiple effects, not just addition. So apart from the oil prices, we're seeing a more broad-based inflation forces will coming back. So I think that's one of the quite critical concerns for all the economies, including the States, including Australia as well.
Well, I mentioned earlier that the market does seem to be looking through this, but we do have some oil traders warning of a potential recession risk. Would that change the picture for equities?
Well, likely, as we just talked about the inflation, if the inflation will be the key number one headache for the economy, that means that First of all, whether or not the interest rate will keep moving higher, and whether or not that pressure, the borrowing cost pressures, will putting a pause or even a brakes into the whole global economy. I think that's sort of the fundamental and sort of something that we could potentially see that happen. In terms of the recession risk, my personal view is I think that's still quite likely, and that still highly depends on how long this oil crisis will last and how much they will translate into the inflation, how much they will translate into the policy reset. We are still at the very early beginning of this stage, but this is the domino effect is just about to unfold.
I want to get back to the recession and central bank response story a little bit later on, but in the meantime, can you tell us about market positioning? Because I mean, I know you say buy the dips. Are there any particular stocks or sectors that you're looking at? And certainly tech, AI stories still powering on through this.
Well, I think it's very interesting if you're looking for how the market respond to today's ceasefire. On the one hand, we do see that, for example, the U.S. equity market futures bouncing up a little bit, but on the other hand, the dollar is down. So what they're telling me is that I think the market will continue to stay cautiously but positive, because the playbook that market seems to believe in, as long as this is a controlled, managed chaos, not a fully collapse, I think markets still have reason to buying for every dip. But on the other hand, the dollar dip today telling us a story, a breakdown story of that previously from a higher oil prices to the high inflation, a higher dollar. This storyline seems to break now. We do see that sort of the dollar is not moving along with the oil now. So I think that will be the pivot for the market, a bit different from what previously, but equity market will continue its belief in that we are working towards a peace talk, but the dollar market might be a bit different.
Well, we've got some big tech names reporting next week, among them Apple, Tesla, a few others. What are you looking out for, and can the fundamentals just power on through this Iran narrative?
Well, these upcoming earnings, as you mentioned, for the Mag 7, just coming at a very tricky timing. On the one hand, the Nasdaq is now coming to the all-time high. On the other hand, it seems the optimism of a recovery, a meaningful recovery, still at the early stage. So I think overall, I will feel quite positive for the upcoming earnings. But I'm pretty sure that all the concerns the market has, including the quite massive expenses of AI, the question of the margin-wise, I think all these concerns will continue to stay as a testing for whether or not that the Nasdaq, the tech stock, could continue its rally before. But if this hurdle clear, I'm pretty sure that the Nasdaq, its all-time high record, will continue to make new highs.
All right, well, Hebe Chen is staying with us because coming up we're going to talk central bankers, particularly Fed Chair nominee Kevin Warsh. He says that he's nobody's sock puppet as he faces questions over President Trump's pressure on the central bank. We'll have more in his Senate hearing next. This is Bloomberg.
Are you going to be the president's human sock puppet?
Senator, absolutely not.
Are you going to be anybody's human sock puppet?
No, I'm honored the president nominated me for the position, and I'll be an independent actor if confirmed as chairman of the Federal Reserve. The president never asked me to predetermine, commit, fix, decide on any interest rate decision in any of our discussions, nor would I ever agree to do so.
Kevin Warsh there giving his testimony before the Senate Banking Committee, and Warsh repeatedly pledged to act independently if he's confirmed as the next Fed chief, rejecting Democratic concerns that he would do the bidding of President Trump, who continues to demand lower interest rates. So for more on this, let's get to Garfield Reynolds, who leads our Markets Live Asia coverage. So Garfield, Kevin Warsh says he won't be a sock puppet. There's other types of puppet, but is that enough for the market to feel reassured about Fed independence?
Well, the market's reaction on the day showed that it wasn't really an issue for them. They were looking at what's going on with oil prices, what's going on with the economy. We had strong economic data. We had an increase in oil prices, so yields went up. There's no rush to price for Warsh to get in and start cutting interest rates willy-nilly. And that's understandable. He was pretty clear that not just that about the idea that he would seek to be independent from the White House per se, but that he did have a concrete program in mind, one that would involve a smaller balance sheet and that would give him greater flexibility to lower interest rates because that lower balance sheet would otherwise act to over-tighten the economy. All that is relatively sensible. There are concerns about how readily some of it could be carried out, and he also offered a little bit of a challenge to investors because he was so clear he didn't want to get involved in forward guidance, and that's something the market has become very used to getting from the central bank.
Yeah, he also suggested that maybe new tools are needed to control inflation as well. So what's he talking about there?
It's not actually all that clear. He talked about better communication. He talked about effectively getting rid of the dot plots, some of which might or might not help on the inflation front. Perhaps there's been some complacency in the markets about where interest rates are going to be because of the way the dot plots are mapping out the reaction function, but he talked about that without offering a huge amount of detail as to what exactly those new tools would be. So until we get clarity on that, it's a lot harder to tell, and the market to some extent is waiting to see how serious his commitment to inflation is going to controlling inflation is going to be. And of course, we need to see more about how the war plays out and the impacts that has on prices in the economy before the sort of questions that Warsh is going to face if he gets approved are actually going to be posed.
Mm-hmm. All right, Garfield Reynolds there, who leads our Markets Live Asia coverage. Hebe Chen from Vantage Markets is still with us. Hebe, I'd like to get your thoughts as well on what we heard from Kevin Warsh today, and more to the point, are you confident that the Fed's independence is going to be intact regardless of who's in charge?
Well, yes, indeed. I think that everyone listening to this Congress press just want to hear about whether or not he could stay independent. I think that he addressed that with confidence, but what the markets still have a question about whether or not he could be an independent person, but whether he will be an independent chair of the Fed. I think that's what they're most concerned about. And independency of the central bank is particularly important at this particular timing because now the country is sitting in the wartime, and everyone knows that means that will bring the odds of crisis much higher than any other time. So whether or not the Fed could stay independent to address all the potential crises in a very independent policy setting, I think that will be quite critical for the economy of the States, but also for the whole market as well. I think that for after today, I would say that my first thought is that I'm not 100% fully convinced about that independency could be safeguarded by Kevin Warsh's today's performance.
Yeah, I'm wondering if part of that skepticism springs from this idea that, all this talk about Fed independence, sock puppets, which we all got a good laugh about, is masking a wider conversation about what Garfield was raising there around new tools to fight inflation, somewhat unspecified, ideas about getting rid of the dots and forward guidance. What did you make of that?
Well, yes, I think as we just discussed, that everyone can foresee that inflation will be a key issue given the oil price stay elevated, given that there's so much things happening that will putting the inflation back on the table. And for the Fed, that's their priority. That's their key mandate. And then giving us, everyone, a guidance, or at least give us a clear picture about how they're going to control, how they face the potential inflation crisis coming back. I think that's pretty critical to protect the credibility of the central bank as they are kind of protecting the economy as well. So I think that lacking that or rejecting to give us everyone a clear picture will be something that will be, I think that it's not benefiting for building up his own credibilities as the chair of such an important and powerful central bank of the world.
Well, if inflation is the key concern here against a backdrop of intense uncertainty, where do you place the likelihood that we don't get any cuts this year from the Fed?
Well, I think that's very likely. That's very likely in terms of that not only the leadership transition of the Fed seems in the vacuum phase. I think moving forward would likely see a policy vacuum phase as well. As on the other one hand, the inflation maybe will be too high, will stay too high for the central bank to cut. But on the other hand, I think we have discussed earlier that if the crisis happens, if the recession can become a meaningful risk, whether or not the Fed could continue to move immediately to react to that. So I think there will be two forces just right in front of the central banks to making a decisions quick enough. I think that will be a key risk that potentially will fit into a recession as well. So this will be a quite confusing and tricky puzzles for the central bank to play out.
Where do you place the risk of stagflation in the US or any other market for that matter?
I think the stagflation, which means that the inflation will continue to stay elevated, but on the other hand, the economic growth will be stalled, and that is likely something that is already played out. We have seen the economy data coming from the United States, coming from Australia, all showing quite meaningful slowing down. For that combination here, that not only will putting the central bank in a very awkward position, but also will putting the uncertainty for all the economies, means the business will be slower to invest, and likely we'll be seeing the high unemployment rate. I think all this altogether will putting a lot of uncertainty for the market, for the traders taking extra risk.
I want to talk to you about the Bank of Japan as well, because we've now got expectations of more tightening getting pushed out to June. What are your thoughts on the Bank of Japan's sort of slow walk towards normality, and what are the risks here?
Yes, Bank of Japan has been always quite slow or actually cautious to respond to inflation. Now the inflation is above the target for over 4 years now. And I just came back from Japan. I do think the price point is much higher than about 2 or 3 years ago. But in terms of because of the new leadership, now everyone is expecting the Prime Minister, the lady, will pull the central bank even more hesitate to raise the interest rate. I think that's probably the tricky part for that we're predicting what's going to happen for the Bank of Japan. But in terms of the expectation, I think it's still likely that at least 1 or 2 hikes will be on the table for the Bank of Japan. As we mentioned, the inflation's been at that level for so long, and that already putting a lot of pressure for the normal human's life and families' pressures as well. So I think they will still do it, but it just will be in the very slow motion mode.
Hebe, as you're speaking there, we do have the Japanese yen on the bottom of the screen. It's above 159 again. What's your outlook for the yen against the backdrop of this slow policy divergence?
Yeah, every time when the Bank of the Japanese yen get into such a quite tricky level, I think the first thought is whether or not the intervention coming from either from the central bank or from the government could be likely happen. I think that will be the market's first thought of that. And the second one is that given the Bank of Japan's meeting is coming up, any guidance or at least will potentially see a bit of a hawkish stance coming from the Bank of Japan will likely to address such a weak Japanese yen. I think that will be putting all together as what the key watch points that is likely to happen in the days ahead.
Mm-hmm. All right, Hebe Chen, Senior Market Analyst at Vantage Markets. Thank you so much for your time today. Still to come, uncertainty from the Iran war is rippling through commercial real estate. Neil Murray of JLL joins us exclusively with his insights on how the company is managing the risks. That conversation coming up. This is Bloomberg. Welcome back. You're watching Insights. Here's a quick look at where markets stand. We do have mainland Chinese markets heading off to lunch. Japan, meanwhile, coming back online. Take a look at the oil price. Let's start there. We got Brent crude slipping a little, but look, it is higher. We're higher than we were yesterday anyway, 98.39 a barrel. The ceasefire has been extended until talks conclude. That's the good news. The bad news is there are no talks, so a lot of uncertainty around this situation at the moment, and we're seeing that reflected in equities markets as well. A bit of sideways drift going on. The Hang Seng weaker by 1.3%. The Nikkei, as it, before it went to lunch, was higher by 0.5%. But the Kospi, which has been performing so strongly this year, having a bit of a quiet day. It's only off by about 0.1% at the moment. Let's take a look at precious metals as well. The gold price catching a bid against this backdrop, 4,762 an ounce. Now, we should have trading getting underway for the rupee. commodity as well. We have seen that soften a little bit after the RBI rolled back some restrictions on currency market transactions. It's continuing to soften a little now, just a little though, 93.69. We were 93.49 before the day's trading began. We're also going to be hearing from India's Road Transport Minister today, going to be speaking at an event in Delhi as, of course, the country grapples with fuel shortages. Now, until now, Asia's largest oil buyers have been able to lean on some workarounds to limit the impact of the war in the Persian Gulf, shielding not only their own economies but those of neighbours competing for cargoes. That luck, though, might be starting to run out. To find out why that is the case, let's get to our managing editor for Asia Energy and Commodities, Clara Ferreira Marquez. Clara, thanks so much for joining us. Can you tell us about the workarounds that some of these countries in Asia, particularly India, to also China as well, have been finding as the Strait of Hormuz remains gridlocked?
That's right. So we're heading into, obviously, we're now at almost 2 months of war, so almost nothing coming through the Strait of Hormuz at this point. Both India and China have been relying pretty heavily on restricted crudes of different types. So for India, that's largely Russian, and we have had, of course, these US waivers. They have taken a little bit of Iranian crude. China, however, taking both Russian and Iranian. That floating storage, that oil on the water, has been an absolute godsend for these two economies, taking a lot of that oil, though, of course, prices have gone up. One of the main attractions of this kind of oil, of course, is that it's typically deeply discounted. But that flotilla, that hoard on the water is beginning to shrink.
So how long until things start to reach a crisis point? We have been hearing that India is considering rationing fuel. What other measures might we see?
I mean, India, first and foremost, might actually put prices up at the pump, which it hasn't done since 2022. So what we'd be looking at there is a little bit of demand destruction on the consumer side. The restrictions would come as part of that. That would certainly help. I mean, India, it will always be able to manage its domestic demand. I mean, the question is whether they will add to the export curbs, and that, of course, has ripple effects all over Asia.
All right, Bloomberg's managing editor for Asia Energy and Commodities, Clara Ferreira Marquez there. Goldman Sachs CEO David Solomon warns that the risk of US recession may rise suddenly depending on how the administration reacts to the Iran war on social media. At an interview in Manhattan, Solomon said that the current forecast for recession remain fairly low, but lasting high energy prices might impact the economy. He drew laughter by remarking that a larger or smaller risk of an economic downturn could only be one tweet away. Well, let's get now to global real estate, where the ripple effects of the Iran war are being felt as well. Rising energy prices, inflationary pressures and geopolitical instability are reshaping investment decisions and also slowing long-term commitments for commercial property. Joining us exclusively now is Neil Murray, Global CEO of Real Estate Management Services at JLL. Neil, thank you so much for your time today. Obviously, so much focus on energy, also fertilizer as well, as it struggles through the great Gulf of Hormuz, or not, as may be the case. But real estate, you might think, be largely immune to this. But can you tell us what trends you're seeing right now?
Yeah. Hi, Paul. Look, at this moment in time, real estate remains somewhat of a safe haven. We carried fantastic momentum from 2025 into this year. Global economies were resilient, plenty of liquidity in the debt markets, treasury, a lack of treasury volatility. So we did carry great momentum. Obviously, things have changed somewhat. We haven't seen the effects of the war really flow into real estate markets yet, but we keep a close watching brief on what's going to happen with inflation, with consumer spending, and of course with interest rates.
Well, JLL does have some major projects in Abu Dhabi, Dubai, Riyadh as well. What are you observing around capital deployment in the region at the moment?
Yeah, again, I mean, the direct effects of the war in the region is what we see first before we start seeing the secondary downstream effects in major markets around the world and here in Asia. At the moment, we're seeing the Saudi economy, where we have a large business, being extremely resilient and very much business as usual. You know, we all hope for a quick resolution of the situation there. At the moment, when we look at forecasts around the world, we see that we saw Oxford Economics this morning saying that GDP levels expect still continued growth if we can manage to get this resolved by the end of April. So we remain hopeful for a speedy resolution. Real estate has still got some fantastic tailwinds from AI-driven demand, for example, around the world, and we hope that those demand signals continue.
Yeah, I do want to talk about AI in a short moment, but just in terms of advice you're giving to clients about short-term leasing, investing strategies in Middle Eastern markets, are you just telling them to sit tight, look through the noise, or are you telling them something else?
Yeah. Look, I think that's the case for all of us. Is trying to understand the difference between sort of noise and real signals in the market. Obviously, there is a wait-and-see approach in the Middle East itself, but investment continues. We see it around the world. As I said, that AI specifically driven demand, the desire to occupy the most important and most in demand spaces around the world. Digital infrastructure demand remains at all-time highs, and we're seeing demand in logistics space extremely high as well. So, look, I think that real estate remains a really exciting home for capital at this moment in time.
Yeah, a moment ago you were talking about the resiliency of the projects in Saudi. So once this conflict is over and will end, what do you anticipate in terms of a return of confidence or of a rebound?
Yeah, I mean, it all comes down to how long this goes on for, and as said, the macro impacts and downstream impacts of the war. It's very difficult to predict at this moment in time. We do see real resiliency, though, in the real estate markets and availability of capital. JLL is now the sort of largest intermediary of real estate debt in the world, and we see increasing capital allocations to real estate. And should we get a resolution in the short term, we expect that to continue.
So how does capital deployment at the moment in the Asia-Pacific differ from the global market, or is there not much, or is there a lot of similarity at the moment?
I think a lot of similarity. Global capital is favouring innovation hubs, is favouring, obviously places like Beijing, Singapore. India is a fantastic market at the moment with that wonderful balance of sort of high GDP growth and fairly contained risks. So, market demographics in India as well is creating fantastic investment possibilities. The global capability centres there, of course, driving huge demand, despite some of the scare comments around AI impacting that.
Yeah, well, AI is, of course, a two-sided coin here. I mean, it's powering through the crisis. There's huge demand for data center as well. So can you talk to us a little bit about how that demand is reshaping your business?
Yeah, look, at the moment, I'm very positive about how AI is impacting real estate markets. I think the notion that there's a finite amount of work to be done in the world and AI is sort of taking a piece of that is a fallacy. In fact, we're seeing increased productivity. We're seeing GCC markets in India, for example, what was once business process outsourcing, what was once cost arbitrage is something very different now. It's availability of talent. We're seeing end-to-end processes in big enterprises being reinvented, new ideas, new ways of working. Our Global Capability Center, for example, in Gorgon, we have architects there, we have designers there, so it's no longer a sort of a back office function, but something that's very central to our business. So I think AI is bringing real opportunities for enterprises around the world to rethink how they do business, and I happen to believe that it's going to be a net positive contributor to humans, to productivity of enterprises and to indeed to jobs in the long term.
Well, one of the stories of 2026 so far has been the stellar performance of the Kospi. Those big tech names are really having a moment. So can you talk to us a little bit about data center demand in South Korea? Do you see South Korean companies looking for homegrown real estate, or are they looking to their immediate neighborhood, other countries?
Yeah, I mean, data center demand is always a function of power availability and power resiliency, and obviously capital. The data center demand is absolutely insatiable around the world. We see, projected 12% CAGR to 2030 in data center growth. So I think investors continue to favor data center infrastructure as a home for capital.
I want to get your thoughts on property in China as well. Of course, let's not get into its troubles here, but JP Morgan sounded a note of optimism on China property earlier. What are your thoughts on that? What's your outlook for the sector?
Yeah, look, I think the fundamentals in China is that the second largest economy in the world and a very important geography for JLL and many of our enterprise clients. Beijing remains a real innovation hub. I see, China moving upstream in the semiconductor supply chain. The fundamentals of the economy are improving. We're very optimistic and upbeat about the Chinese real estate market in the long term.
And how about Hong Kong? When do you see commercial real estate finding a floor there?
Yeah, there's been many opinions suggested on that. Again, we're seeing fundamentals improve in Hong Kong, and we're excited by the prospects there. I think the transaction volumes that we've seen coming through the tail end of 2025 and into 2026, the first quarter, give us real optimism about the Hong Kong property market.
All right, Neil Murray, Global CEO of Real Estate Management Services at JLL. Thanks so much for your time today. Still to come, Anthropic's Mythos AI model is said to have been accessed by a few unauthorized users. We'll examine the potential fallout of that next. This is Bloomberg. Welcome back. You're watching Insights. Let's take a look at how Indian markets are tracking. We have been keeping an eye on a few stocks here, specifically HCL reported a net income for the fourth quarter that missed estimates. We're going to hear from Tata Communications and Tech Mahindra later on today. But for now, a little bit of risk-off sentiment. The Sensex off by 0.5%. The Nifty Bank Index not declining by quite the same rate, off by about 1/5% at the moment, which does reflect the broader market sentiment around the Asia Pacific at the moment. Still got the rupee a little bit softer than it was this time yesterday. This is, of course, after the RBI rolled back some restrictions on currency market transactions in India as well. So a little bit of weakness there for the currency. Well, Indian small cap stocks are outperforming their larger peers. Analysts say the rally's still got some room to run as well, with earnings growth expected to stay strong. India equities reporter Alex Gabriel-Simon joins us now from Mumbai. So Alex, what's driving the recovery in small caps this time?
Yeah, well, things are looking a little bad today, but this month so far, there's been an improvement in sentiment globally. But in India, it was much more pronounced in the small cap space, which are stocks beyond the top 250 in India. If you look more broadly, right, earnings growth in India has been more concentrated in the small cap space, so to say. If you're looking at large caps, AI-led disruptions in the IT segment has been a worry for investors. At the same time, consumption growth has been slow. But when you look at small caps, there are niche segments of the market which are still doing very well. Renewables, for example, or manufacturing. So investors are now looking more closely at the space, so to say. And if I'm tracking a small cap gauge in India, that has outperformed the Nifty this month by the most in nearly a year.
So what is the small cap rebound going to mean for the market? Tell us about the broader outlook.
Well, this is a segment that is concentrated by retail investors. Especially foreign investors have not looked at it very closely. So this would mean that retail investors who have been seeing a lot of red in their portfolios over the last year, they're finally going to be a little bit more happy. And that might mean more mutual fund flows going forward, which has been steady and been keeping the market afloat so far.
So tell us about some of the valuations that we're seeing in small caps.
So this has been the biggest concern for investors in this segment and overall for India as well. But when you're looking at it, even after the correction over the past 18 months, small cap valuations are still one standard deviation above its long-term averages. But then for bulls in this segment, they're looking at earnings much more because they're not seeing any growth in the large cap stocks, right? So even at slightly higher valuations, they are being selective and finding spaces in the market that are still okay or not that expensive.
Earlier this year, foreign investors were getting out of India as fast as they possibly could. There's some signs that they're coming back now. How are foreign investors viewing the small cap segment and the market overall?
So overall for the market, I think foreign investors have pulled out about $18 billion from India this year, last I checked. And that's a large value, right? It is almost near what we saw last year. But if we particularly look at this segment, they've historically not touched small caps much. But when we're looking at shareholding patterns, we're increasingly seeing foreign investors dabbling into this segment, right? And given what's been happening with earnings, we can expect some sort of return. And if you're looking at last week, actually, foreign investors were net buyers of India. So hopefully for bulls, this continues, and that might mean an extension of this rally.
Bloomberg India equities reporter Alex Gabriel-Simon there in Mumbai. Thank you so much. Well, Bloomberg has learned that a small group of unauthorized users has accessed Anthropic's new Mythos AI model, which the company itself warns is so powerful it could enable dangerous cyber attacks. Let's get more on this scoop with our Asia technology editor, Mark Anderson. Mark, Anthropic was warning about exactly this last week, and now it's happened. What do we know about the unauthorized access?
Hi, Paul. Yes. So Bloomberg is exclusively reporting that a third-party contractor for Anthropic gained access to Mythos and shared that access with a handful of users in a Discord channel. Now, those users say they have no nefarious intentions. They're just AI enthusiasts who want to learn more about the model. And Anthropic has also said that no disruptions have been noticed within their systems since this breach was reported. But of course, it raises very sensitive questions for the company at a time when everyone is wondering just how powerful is Mythos.
Yeah, so that's who got unauthorized access. Tell us who's got approved access to Mythos and what they're doing with it.
Yeah, so Anthropic has warned of the dangers that this AI model presents, and it's shared early access with a small group of tech companies, including Apple, Amazon, and Cisco, as well as a select group of U.S. government agencies. Treasury Secretary Scott Bessent summoned a group of Wall Street's biggest banks for a closed-door meeting earlier this month to warn them about the dangers of this AI model. So, yeah, we can see that a lot of people are starting to worry about the capability of Mythos to carry out cyber attacks that would normally take humans, 2 or 3 steps to complete.
Yeah, tell us a little bit more about why it is so dangerous, and presumably there's probably more powerful models coming.
Yeah, exactly. Well, I think it's very dangerous. Anthropic itself has said that it has the ability, that Mythos has the ability to carry out advanced attacks on any operating system or browser. So, that has really sparked a lot of concerns. We've also seen other AI models from Anthropic. I think it's the Claude model has been used to carry out breaches in Mexico. So as AI models get more advanced, and this is by all accounts more advanced than Claude, worries are going to increase that we're going to see more of this kind of attack.
All right, Asia Technology Editor Mark Anderson there. In other news, Mistral AI says the French startup has evolved from an open source provider into a full stack AI platform focused on helping large enterprises customize their models. Their chief revenue officer told us about how they're positioning as complementary to major industry players.
we very much found our niche in the context of larger enterprises needing customization of models and portability of models everywhere. It means that we coexist with the players you've mentioned, and we really found our stride in helping organizations really achieve end-to-end business transformation. Use cases where off-the-shelf AI is not sufficient, when you're going to need really to deploy those models everywhere and customize them to your own IP, to your own data, really Mistral is finding great leadership in that segment of the market.
How much revenue comes from outside of France and outside of Europe?
Yeah, we've seen a tremendous, I would say, acceleration globally. So we have quite a bit of a customer in Asia today, Ministry of Defense Singapore, the Ministry of Home Affairs in Singapore as well, and more momentum in Asia. In the United States, we're having also quite a bit of momentum with customers like Cisco, Dell, all the way to Snowflake. So the momentum that Mistral is experiencing is very global in nature. And that's because the need of customization and the need of portability is not only a geopolitical topic. It's a topic that's concerning all enterprises that are really trying to achieve return on investment. And for that, customization is a key topic for them wherever they are.
Is Mistral AI fully committed to the US?
We are very committed to the US, very committed to all markets, and most importantly, very committed to the larger enterprise that's really in need to accelerate their transformation.
That's Mistral's AI Chief Revenue Officer speaking to Bloomberg earlier. Now, before we go, let's take a look at tomorrow's show. The president of the Thai Stock Exchange will give us their outlook for the Thai market in the face of global disruption from the Iran war. Also, BCG Managing Director and Senior Partner Aparna Bharadwaj is going to be sharing her insights on global trade amid geopolitical uncertainty. Well, that is it for Insight. Stay with us. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.